Let's continue on with our Wrap the Week segment. We're going to start with a poll. We often have a poll running on our StockCharts TV page, right on the StockCharts website. Also on social media, we'll throw a couple polls out every week. Would love for if you would respond to that, and hopefully it helps nudge your own thinking in terms of where you're looking. This most recent poll was, which asset class do you think will perform the best over the next 3 months? And I gave you three choices: gold, bonds, or the S&P 500 stock. So basically, paper, rocks, or scissors is the way we usually think of this. So gold, 22%, bonds, 21%, which means 57% of you said stocks. And it's interesting looking at those three charts and getting to the S&P 500 here momentarily. It's hard to argue against the uptrend in stocks, and it's always interesting to see what's happening as we're asking this poll. We opened that poll on Tuesday, so from Tuesday through today, it's been a pretty strong bounce higher, pretty sudden move upwards as gold and bonds have taken a bit of a breather. The S&P 500 has moved higher. We'll talk briefly about bonds. We'll probably talk about this a little bit more on Monday's show, and we talk a little bit more about the macro environment. But the chart of the TLT is an interesting one, and if you know your candle patterns, it might be a little hard to see this. Let's go to a 3-month chart, and we'll go candles. Here we go. Does anyone know what this candle pattern is that I'm highlighting? It happened on Monday and Tuesday of this week. The correct answer is the dreaded bearish engulfing pattern. This is where you have an up candle with the close above the open. The next day gaps higher on the open, but closes below the first day's open. And so it's basically the day two open to close range engulfs day one. That's why it's called a bearish engulfing pattern. This is a classic candle reversal signal, indicates the exhaustion of a short-term uptrend, and the next couple bars should be lower. So that signal that you saw on the TLT suggested that bonds had rallied a little too quickly. Expect a bit of a short-term bounce to the downside. You can see the momentum was actually a little bit lower, so you have a little bit of a bearish divergence there going into the high at the beginning of this week. So certainly indicating a potential for bonds to come off a bit. They have. The question, though, is what's next? And I think if I had to answer this question, which I did not, over the next 3 months, because of that time frame, I would probably say stocks, only because the base case I've had for the whole year has been a repeat of 2010 in some form, which is a choppy period with some drawdowns, but overall finishing the year stronger. And I don't see bonds or gold as being able to overtake the run I think stocks are most likely to have. What I have been expecting is a little more of a pullback before that resilient rally to the upside, but that's not what we've really seen. Every pullback that we've started to have has really not materialized into anything more significant. In this week's brief pullback into the Monday low before resolving to the upside, I think two things that does. Number one, it reinforces the importance of the 50-day moving average. And if you've not understood or respected the 50-day moving average and how that has served as an important support level, hopefully now you've seen that. Just in the last 2 months, we've now had a couple pullbacks, same as we did in May and in March and in January. Every one of those times, February as well, we keep bouncing off of the 50-day. So number one, it reinforces the importance of that as the line in the sand to pay attention to. The second thing, what it suggests to me is the more times you bounce off a level like that, if and when we eventually break below the 50-day moving average, which I guarantee at some point we will break below the 50-day moving average at some point. It may not happen today, but at some point we will do it. And when we do, the challenge is when people have been expecting support there for so long, when it finally does not hold, and when people start to recognize and realize that that is no longer a valid support level, that's when things can get very ugly very quickly. When there's broad distribution, when people recognize that the picture has now changed, things are a little different. We're no longer in the environment where the 50-day is just a buyable dip indicator, and all of a sudden it's a signal of a break in something further. So I thought potentially this week was going to be the time when we had that break. We have not seen it yet, which I think is just setting us up for another rally, which we are now in the midst of, and setting us up for at some point a rollover and a break of that 50-day. I think is becoming more and more of a negative sign when it actually finally happens. Now let's wrap this week very quickly. We're going to look at today's trading just briefly, then we'll focus on the week and how that played out, and then we'll finish off looking at the Mindful Investor Live ChartList. Today was about communication services leading to the upside, and look at charts like Facebook. I was chatting with Larry Tentarelli, who was on the show recently, talked about this stock not too bad in terms of its return. Again, pulling back to the 50-day as the market did. rotating to the upside, up over 5%, just narrowly, missing the overbought region, but making a new 3-month, 6-month actually relative high. Nice, move to the upside. And again, charts like that being strong, charts like Microsoft continuing to make new all-time highs. The market cannot be too bad when stocks like this are moving to new highs. There can be choppiness, there can be areas of potential relative weakness, but overall the trend remains very strong. And I think that's what we're seeing. Interesting on a day like today, where we're making new all-time highs, sector number 2, utilities, which is actually very defensive. Sector number 3, also very defensive, consumer staples. So on a day like this, when we're bouncing higher, consumer staples outperforming consumer discretionary, which is an interesting one. At the bottom, the cyclicals, which have had a place of honor at the lower end of the sector summary table for quite some time now. Energy, the only one of the 11 S&P sectors down today. All the other ones were in the positive. The S&P up about 1%, mid and small caps lagging behind, and the VIX back around 1725. Interest rates bouncing back higher today with the TLT, as we mentioned, going down about 0.2%. The dollar index essentially flat, remaining around 25. Gold, precious metals down today, while the rest of the commodity complex actually, pretty much mixed, to be honest with you. But as I mentioned, energy prices a little bit lower. Cryptocurrencies have rallied very nicely, but have now stalled out a little bit. Everything but Bitcoin and Ethereum down today. Those first two were sort of flat for the day, chopping around quite a bit, remaining above that 32,000 level for Bitcoin. Let's look at how the week actually played out. And this is a chart using sort of the basic asset allocation ETFs that I tend to look at, as with Bitcoin in there as well. I'll walk through very quickly what these different lines indicate. And you can see we're starting the clock, the last Friday's close, and looking to where we're at right now. The S&P 500 finished the week up just under 2%, rounding up to 2%. So a nice strong move to the upside overall. And again, that's with Monday into Tuesday jumping, or Monday really, Friday into Monday going lower. All of that taken back and more, with the S&P up 2%. What underperformed the S&P this week? The crude oil using the USO is here, up 0.7%. Right along the same lines, we had the dollar index and also bonds up 0.2% for the week. Two things were down on the week. Gold was actually down 0.5% using the GLD, and the laggard of the week was the emerging markets index, EEM, which was down 2%. That, if you look at the relative strength of EFA versus EM, right, which is developed versus emerging markets, very much favoring developed markets right now. What outperformed the S&P? Just a little bit more than the S&P were small caps, which actually up 2%, which is just an interesting one. We probably you may not have expected that given the strength that you've seen today, especially stocks like Facebook and others. But remember, midweek, you had that bounce higher with small caps actually raging and outperforming midweek. That sort of tapered off yesterday, but overall still enough to outperform the S&P. The strongest with two asset classes, or how I describe them, the NASDAQ 100 was the best, just under 3%, right about that same amount, about 2.9%. The price of Bitcoin, which was up there. So overall, a healthy week for stocks by the end, Friday to Friday. And again, that was coming off of a weaker move Friday, the lower move into Monday, and then recovering very nicely. Let's continue off, finish the Wrap the Week segment, looking at the Mindful Investor Live ChartList. As a reminder, you can access this at any point by going to the articles tab at the top of StockCharts. Go to my blog, which is called The Mindful Investor. And at the very top, you'll see a gray button for live chart list that'll take you right to this page. We'll start with the market trend model. We review this every Friday. Let me just refresh the chart to make sure it is updated, which it is. My medium-term model has been negative since May. It still remains just right below the zero level. It has resisted this upward pull of stocks and gone higher. And it's interesting, what I generally think of that as my risk on versus risk off meter. It does not tell me when that turns negative to sell everything indiscriminately. Just like if things are going down and it rolls higher, it doesn't tell me to just randomly buy anything I can see. It tells me whether to think more risk on or risk off, think more about potential reward or more about potential risk. It does not tell me to stay away from trends which are working. So charts like Microsoft and others that are in good uptrends that continue to work, I don't see a reason why you would want to get away from those until the charts themselves tell you to do it. When this model turns negative, which it has been since May, it tells me to think about lines in the sand, which has been very helpful on things like gaming stocks and airlines and energy stocks and financials, which had been in good phases and have all rolled over to the downside. At some point, if we continue higher, I would assume that this would rotate back to the upside. What it tells you is just the momentum has not been super strong in these last couple of weeks, enough to push this model back to the upside. The short-term model has remained essentially bullish for months and months, given the short-term strength, how Friday tends to finish pretty strong for the S&P 500. The daily chart of the S&P we talked about briefly, and again, I think bouncing off the 50-day is the story. As we sold off to the 50-day, as we reminded you on Monday, this is a level that has proven as support many times. I would assume that that serves as support until proven otherwise. It has not been proven otherwise just yet. The S&P is moving higher. I was asked, is this a bearish divergence? And the answer is it could be, but you don't know yet. Remember, this is an active move, right? So we're actually in the throes of this uptrend. If we would sell off at the beginning of next week and confirm this as a higher high on lower momentum, that's when you could call it a bearish divergence. At this point, it's still an uptrend with momentum so far improving in the short term. Some of these breadth indicators, as you know, are not updated yet for Friday's close, but as of Thursday's close, you still have this very clear divergence with most of the cumulative advanced decline lines and the S&P 500 on a price basis, especially with mid caps, with small caps, and most importantly, with the New York Stock Exchange common stock only, which is on the top. Look at how this has remained above its 50-day moving average this whole time, rolling below it, making a new swing low after making a lower high. So the S&P is going higher. Most of these breadth indicators are negative, are actually going lower. What that tells you is underneath the hood, the market is not as strong as the S&P index itself would make it appear. The fact that the S&P advanced decline line is still holding up shows you that when in the large cap space, things are good. And at the end of today's show, one of the 3 and 3 is a beautiful chart that I think tells the story of the last 3 months and what I would call the stealth correction that we've actually been in this whole time. So what this tells you is, depending on what your portfolio looks like, you could actually be feeling a good amount of pain here. And I think there's opportunity to manage that risk if you focus on where the breakdowns are happening. We are still seeing a decent number of new highs, not a dramatic, healthy number that you would like to see in a strong uptrend. Now, this is not updated for Friday yet. We'll see if we get, as the S&P itself making a new 52-week highs, if we see a lot of stocks, things like Facebook and others are certainly able to do that. So I would assume that ticks higher a pretty good amount. We'll have to see. Notice the absence of new lows, and again, it's a little bit of a miss because the 52-week low for most stocks is really far away. We'd have to have a dramatic sell-off on most charts to trigger a 52-week low. Looking at something like 1 month lows might be a better indication of when that uptrend is over. As of as of Thursday's close, it's worth noting that still only 47% of the S&P 500 members are above their 50-day moving average. Again, these breadth measures tell you that the average stocks are still not a big part of this uptrend. It's large cap that are leading it, and it's a relative small number. It's not overwhelmingly positive. The last thing I just wanted to leave you with, because we did talk about sentiment yesterday, so I don't want to beat that too much, but I just wanted to get a chart of small caps. I think the last piece of this puzzle is the underperformance of small caps. If you start the clock in March, small caps, with the exception of a couple weeks there in May into early June, small caps have been underperforming until proven otherwise. This tells you, these ratio charts will tell you to stay away from small caps and be leaning into large caps, to stay away from value and to be leaning into growth. Those trends are persisting. They are continuing even with the choppiness that we've seen this week. And I would assume that those trends are in place until proven otherwise.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.